Technical analysis is used to inform traders and investors on when to enter or exit a market. Traders often use many types of chart patterns as common tools to inform their trading strategy, with one of them being the flag. Flag patterns resemble a flag on a flagpole, hence the name. Depending on the direction of the trend, they can be either bullish or bearish. Let's dive deeper by breaking down the main characteristics of flag patterns. Here's a representation of a bullish flag. And here's one for a bearish flag pattern. They more or less have the same structure. The first feature of a flag pattern is the preceding trend, also known as a flagpole. In a bullish market, the pole forms as a result of a price increase led by a significant bullish momentum that lasts until a new support level is achieved. A bearish flagpole, on the other hand, is quite the opposite, in that it is formed due to a significant bearish momentum and is therefore downward trending. The other major component of a flag pattern is the actual flag, also known as the consolidation phase, illustrated by parallel tops and bottoms. In the first stage of the phase, there's a subtle difference in volume pattern between the two flags. A bullish flag is characterized by volume increases in the flagpole formation phase and declines at the beginning of the consolidation phase, while in a bearish flag, the volume pattern decreases in the flagpole phase and increases at the beginning of the consolidation phase. The last stage of this phase is the breakout point, a specific point at which the asset price moves above or below the resistance level. This point is used as a confirmation point for traders for whether the flag is truly bullish or bearish. When the demand exceeds the supply, the price breaks outside the flag above the resistance, and prices continue to move upwards, completing the formation of a bullish flag. On the other hand, when the supply is more than the demand, the price breaks below the support and continues to fall, confirming a bearish flag. So, how do traders use bullish and bearish flag patterns? Some use the flag pattern as a stop loss to reduce possible losses. In a bullish market, some traders might use the length of the flagpole to set a profit target. However, not all flag formations are as obvious as the ones shown here. And of course, no indicator should be used as a foolproof signal to go all in on a trade. Always manage your risk accordingly. Comment on other technical analysis strategies that you know of.